All right. Good morning, everybody. Thanks for joining us today. My name is Carolyn, and I'm with Midwest Manufacturers Association. And today, our webinar is in our manufacturing industry series and entitled Understanding True Product Costs and Why Most SMB Manufacturers Get It Wrong. Our presenter today, we're happy to have David Altemir. He's president of Altemir Consulting. And at this point, I'm just going to turn it over to you. And please feel free to leave any questions you have in the chat, or you can turn off your microphone and join it and just to ask away. So here you go, David. I'll turn it over to you.
Okay, thank you, Carolyn. Hello, everyone. Just give you a little background about myself. Yeah, I'm president of Altemir Consulting. We are a manufacturing consultancy. We're headquartered in Dallas, Texas. My background is mostly aerospace and medical devices. I spent 20 years in the aerospace industry at NASA, Bell Helicopter, Boeing, doing spacecraft, aircraft, helicopters, UAVs, and then spent some time in medical devices doing orthopedic implants and class one, two, three medical devices. And then spent the last year 8 years doing manufacturing consulting as an independent consultant and banded together with some other consultants that were former operating executives. And so we cover pretty much the entire order fulfillment pipeline, and I'll speak more about that in a moment. I've done about 3 dozen ERP implementations. A lot of them were for MRP Easy, which is an ERP system that is designed for small manufacturers. I've done about 2 dozen implementations of MRP Easy. Um, and I'm also one of our unique expertise is production scheduling and planning. So that involves inventory optimization, finite capacity scheduling, production control, those kinds of things. And we work with any and all ERP systems. I've probably reached out and touched, well, I think it's over maybe a dozen and a half different ERP systems, everything from SAP to QuickBooks. Um, I've written a book called Lean MRP that is really a book about finite capacity scheduling and how to establish a control system that's lean using a computer. Uh, the whole point of it is to try and establish a control system in a manufacturing business that promotes on-time purchasing and manufacturing. So that's a little bit about myself. Let's talk about product costing. So what's product costing? Well, first of all, let's differentiate between costs and price. And I think most everyone intellectually understands the difference between cost and price, but I do see it conflated an awful lot. So costs, of course, are what it costs you to make your product. So all of your material costs, your labor costs, things like that. And then price is what you sell it for, and the difference between price and cost dictates what your profit is. So if you're interested about things like profit, you would keep a very close eagle eye on costs. And of course, costs come. There are costs, and then there are costs. It comes in a lot of different flavors and varieties. So let's try and break it down. When we talk about product cost, we're really talking about these three primary cost buckets. So direct material, so the material that goes into your product and that can be measured, that's a key consideration. That's what makes it direct material. And the direct material should include other ancillary costs like inbound freight, customs. You know, the terminology is usually landed cost if you're importing materials from abroad. But any kind of freight or fees or something that tolling fees, those kinds of costs should be absorbed and allocated in the direct materials when you receive them at your site. So as soon as that material arrives at your operation, you should have a system that will allocate these costs. so that if you buy $100 worth of material, but it took you have to pay 10 additional dollars to get it shipped in and cover other fees, then the balance sheet should hold $110. MRP Easy, incidentally, has a fantastic way of allocating those costs and making it super easy to automatically allocate those costs. If you don't have a system that will take care of that cost allocation, then it becomes a manual process, or worse yet, it doesn't get done at all. Direct labor, of course, that's the cost of your shop floor personnel and manufacturing overhead. Manufacturing overhead is a basket of an awful lot of things. So let's drill into that a little bit. It would include things like indirect materials. So there's a distinction between direct materials and indirect materials. What's the difference? Direct materials are materials that go into your product and can be measured. So you know very precisely how many units of material go into your product. There are some materials where it's hard to do. The classic examples would be things like paint, mechanical fasteners, electrical wiring, stuff like that, adhesives. You don't, you know, when you paint something, you don't exactly know how many gallons or kilograms of paint you've applied to the product. You usually don't have that precise process control. And because there's a big fuzziness around how much material is being utilized for each unit product, it's hard to measure. And inevitably, your inventory becomes inaccurate. And so you treat those materials differently. You call them indirect materials. And then the cost of those indirect materials will get book kept as manufacturing overhead. Shop supplies, these are materials that do not go into your product, but are yet needed for production. So things like safety goggles, gloves, mixing sticks, buckets, cutting tools, cutting fluids, all of those, hand tools. People call them consumables. They're used in the production process, but they don't actually go into your product, whereas indirect materials and direct materials do go into your product. It's still a cost that needs to be accounted for, so it's treated as manufacturing overhead. Indirect labor. So, in contrast to direct labor, this is usually labor that doesn't reside 100% on the shop floor. It's a support role. It's needed for the production of the process, but they're not actually literally hands-on in producing the product. They are adjacent. Things like production managers, supervisors. They could be working supervisors, so that would be, there are certainly judgments to be made as to how you want to classify and account for these different costs. But production managers, your purchasing people, your warehouse personnel, quality assurance inspectors, all of those folks would be considered indirect labor and would form a component of manufacturing overhead. And so you'll need a system that will be able to basically collect all of these costs and report them out as as a cost that goes into your product, if not directly, indirectly. Facility and maintenance expense, that would be for your factory. Utilities expense, and I'll just give you a little bit of theory here and contrast it with how it really happens. The theory is that let's pretend that you have 100,000 square foot facility and 80,000 square feet are factory, and the other 20,000 square feet are offices. When you get your utility bill at the end of the month, theoretically, 80% of those utilities should be treated as manufacturing overhead, and then the remaining 20% would be book kept as an operating expense. That's that's how it's supposed to happen. It's a pain in the neck to do that kind of cost allocation manually at the end of each accounting period, and so people tend not to do that. They'll just count it as a operating expense. But anyway, that's the theory and the practice, and theoretically, it should go into overhead. All of these things will constitute your product costs. So when you ask yourself what's the cost per unit, it would be all of these things, and you'll need a system to collect those costs and percolate them up and roll them up into a product unit cost. There are other costs that we talk about what is a product cost, but let's also think about what isn't and should be excluded. Inventory adjustments. So that is part of your operation. So inventory adjustments are part of cost of goods sold, but they are not what you would normally construe as, manufacturing overhead or a product cost. So they're just kept on a separate line item. And of course, there's everything that are the quote unquote below the line costs, your operating expenses, your interest expenses, depreciation, taxes, all that kind of stuff. Let me just talk a little bit about freight because you see, I'm making a distinction between inbound freight and outbound freight. Inbound freight is the cost associated with bringing raw materials into your operation. And as I described earlier, those costs should be allocated to your direct material. So upon receipt, these ancillary costs should get absorbed. And you should have a system that can do that, like MRP Easy. Outbound freight's a different deal because you're producing a product and then, part of the sales fulfillment is shipping it out to the customer. So the outbound freight cost technically is a selling cost. And a lot of people just call it freight, but it's useful to have a distinction between what is incoming and outbound, inbound versus outbound. So that is product costing in a nutshell. Why is this important? Well, if you're in the business of making something, it's awfully useful to know how much it costs so you can assure your profitability and make sure that your pricing is right. You want to know, are you charging enough for your product? And there, we could have a completely separate discussion about uh, pricing. There's lots of ways to do pricing, the market-based value-based methods, cost plus whatever, theoretically, whatever the market will bear is the best way to price the product or the service. But you should always be able to test it and validate it against what your cost of production are. And that's where the cost per unit, your product costing becomes important because it tests whether or not your business is going to be profitable. And if you're a new business, boy, nowhere is that more important. So you really do need to, if you're starting a new business or a new product line, from the very inception, it really pays to make sure that all of your ducks are in a row with regard to collecting and percolating and analyzing all of these different cost varieties so that if you're charging enough for your products. I've been in situations where we do a cost study and we found out that one of our most popular products was going out the back door essentially with $100 bill wrapped around each unit because we were underwater on the pricing and our costs were too high. So it's definitely important stuff to know. It gives you, aside from pricing and profitability, it gives you management information that you can put to use. So when you know your unit costs, that it means that you're collecting costs in a way that you can measure labor efficiency. So that is incredibly important if you are a manufacturer. Um, it's the sort of thing that you can improve with a continuous improvement um, process. Yeah, I've been in situations where we were able to improve labor efficiency from 70 to 100%. Is actually more than 100%, because this is all relative to a cost standard. But anyway, knowing your costing helps you manage your staffing and your training and continuous improvement. and it helps you prioritize which products, materials, and I should also say which areas, which parts of the factory, which suppliers. It's a important figure of merit to put together a Pareto list of different things that you need to look at with regard to cost optimizing, inventory optimization. We can do an inventory simulation and tell you what your ideal inventory should be and how much it would cost. But to do that, we would need to make sure that your unit costs are accurate and correct. And it also gives you a prioritization for continuous improvement processes. So some common mistakes, and there's a lot of them because there's a lot of complexity, quite frankly, in how activity on the shop floor, how purchasing with your suppliers, the way that that's all conducted results in transactions that then percolate dollars upwards, and they get aggregated into reports and they get classified in GL accounts and so on and so forth. So there's kind of a whole network of data and information flow to make sure that things work correctly. And at the root of it is your item master data. And I humbly tell you that I can walk into a company and look at their item master and in 10 seconds tell you if that company is problematic or not. Because the items, your part numbers, your descriptions, all of the data that goes along with that basic data drives purchasing, it drives inventory, it drives manufacturing, it supports sales, and it supports cost accounting. And usually it's not set up correctly, or at the very least, it's not set up optimally. So that's one of the bigger issues that you need to tackle. Transactional discipline is lacking. So the way that material or labor costs are collected is not exactly good. Material management may be problematic. Inventory control may be loose. That maybe the transactions are being performed and they're being performed correctly, but they're not timely. So the transactional discipline needs to be there when you're working with an ERP system. And if it is, it just makes life so much easier. I spoke earlier about freight, so not differentiating freight versus as inbound versus outbound. It's best to do that. And another thing that I see happening is you'll have certain fees like the freight costs themselves or customer service fees or vendor service fees treated as inventory items. I have more than on one occasion looked at someone's system and I would see that they had an inventory, a standing inventory with 10,000 units of freight in on the balance sheet, and it's that's a weird thing. So don't do that. These are not freight and service fees and things like that. They are not inventory items. So don't let them sit on the shelf in your system. Indirect materials and shop supply treated as inventory items. Those things, just because of the nature of measuring usage, um, sometimes they're best treated as non-inventory items. What's the point of tracking something in inventory if that inventory is uh, going to be wrong consistently or inaccurate? The one of the primary benefits of having accurate inventory is so that your system will tell buyers what to buy, how much, and when, and do it accurately so that you don't run out of material and you keep a lean inventory. That won't happen if you've got a bunch of stuff that isn't right. If you have freight, if you have indirect materials and shop supplies that just are going to give you wrong purchasing signals. And if you allow wrong purchasing signals to exist in your system, it means that the system cannot be believed. And ultimately, what will happen is buyers will use Excel spreadsheets to decide what it is they need to buy. You're spending an awful lot more time and energy and attention trying to do something that the system could readily give you and give you accurately if it was set up and used correctly. Outside manufacturing services that are handled correctly. Oh, let me go back here now that I'm reminded. In our cost categories, one of the things to consider is outside services. So if you send something out for painting or anodizing or uh, services that you do not perform in-house, but you send the product out and then they bring it back in, that needs to go into one of these three buckets. Um, different systems treat it differently. Sometimes it's regarded as a direct, they call it a material cost, or sometimes it's a labor cost, sometimes it's an overhead cost. You just need a way of making sure that those outside services are um, are accounted for correctly. Relying too much on physical counts and adjustments. Um, a question I ask is your inventory accurate? And they'll say yes. And I say, is it accurate because you are frequently or often counting inventory? It says, oh yes, yes, we do a full wall-to-wall inventory every month. Um, it's not supposed to work that way. That's an awful lot of labor. Doing a physical count is a lot of work. And so making it a way of life and putting too much reliance on the physical counts is um, is not good. It's too much work, but also it means that a lot of material cost is basically ending up on your income statement as adjustments rather than direct material. So that's a red flag if that's happening. Not consuming raw materials properly in production, that is probably, I bet you that's the number one issue for a manufacturer because uh, one of the things that is unique about manufacturing is the phenomenon of consuming raw materials, absorbing that into work in process inventory, and then when you complete the production order, it gets realized as finished goods inventory that you then sell. So the flow of dollars from raw materials to WIP to finished goods is not going to be good. It's going to be inaccurate if you're not consuming the raw materials properly in production, and that happens very often. Not allocating overhead when needed. So you saw how, I mean, it can be complicated. It's not complicated. You just have to consider all of the cost elements that go into overhead and just make sure that they're being collected properly. Um, but and there are different accounting methods. But if you need to know your overhead, it just needs to be collected and book kept properly. And then not drawing a clear distinction between raw material, WIP, and finished good inventory. If you're a retailer, um, then you have a line item on your balance sheet called inventory. And if you're using QuickBooks, for example, and you turn QuickBooks on for the first time, they'll give you a sample chart of accounts and they'll have inventory. But if you're a manufacturer, you need to think of three different flavors of inventory. You've got raw materials, work in process, and in finished goods. And so that distinction needs to be clear, and so that you can see how fast your raw material is turning, how fast your finished good is turning, and how fast your WIP is turning. So all of these things are common mistakes that small manufacturers make, and they affect product costs and inventory accuracy. So let's talk about how costs are percolated up from the operation ultimately to land in your financial reporting. Cost accounting versus standard cost accounting. So those are the two uh, typical costing methods. So let me describe the difference. In actual costing, you have what is the concept of an inventory cost layer. So the concept is let's say that you buy steel and you buy steel in January for $1 a pound And then in March, you buy the same steel, this time for $1.25 a pound. So what should happen if you're doing actual costing is your inventory managing system would have uh X number of units valued at $1 per pound and Y number of units in inventory valued at $1.25 a pound. And you aggregate them together, and that would go into your raw material inventory value. But they are being managed in the system as two separate cost layers. So when you consume material, those costs will be absorbed into the direct materials line item that we talked about earlier. And to do that, usually in actual costing, you use first in, first out rules uh, to to decide which cost layer you're going to be consuming. So you have a production order on the floor. Um, you would the system if you used FIFO. There are other methods, but if you used FIFO, that's the most common one. You would be consuming the material that came in January at $1 per pound, and that's the actual cost of the material that would be absorbed for that iteration of product manufacturing. In contrast, standard costing, you basically you have to do an exercise to determine to calculate a standard cost. And you'll just say, oh, standard cost for steel is $1.17. And maybe you'll do that exercise a couple of times a year, every quarter or once a year, whatever, however frequently you decide to do it. But it's a standard cost, and the standard cost of the material is what gets absorbed. So there's no detail in the fact that the cost of steel changed at that your actual cost of production varied over time. So the benefits of actual costing is that it gives you, and this is a byproduct of actual costing, really. To do actual costing, you have to have paths, very carefully, precisely defined paths that dollars will use to flow from raw material to WIP to finished goods. And those paths have the added benefit that they are useful for quality assurance purposes. And so that's where I'm talking about material traceability. So if you have an actual costing system, you will know that that job that produced that product that was shipped to Mrs. Johnson in Kentucky on the 4th of July, you'll be able to trace that material that went into that product to the PO and to the vendor and to the delivery date and to the material and perhaps even to the vendor's material lot number that they can use in their system to trace it back. So if this is important in some industries for quality assurance or regulatory purposes. So that is out of the box and automatic if you have an actual costing system. Incidentally, MRP Easy is an actual costing system, and it does this completely automatically out of the box, the material traceability. Very useful for food manufacturers, medical device manufacturers, uh, businesses that need that sort of thing. You're also able to know the profitability of each order. So if you consumed the dollar per pound material in one manufacturing order versus the $1.25 per pound steel, you'll you will you will be able to see what the actual profitability of each order is, and then you can trend that data, and it's very straightforward. In contrast with standard costing, the disadvantage is that because you use the standard cost, that it's going to deviate from what the actual cash flow that went out the door to your vendors, for example. And therefore, you're going to incur a variance. So you costed it at a standard cost of $1.17 per pound, but in March, we know that we actually we paid the vendor $1.25 per pound for that steel. So that variance needs to be resolved as a manual process at the end of the accounting period. So that's an accounting thing. And it's just another thing that needs to be done that you would not need to do in actual costing. But For some businesses, that's a benefit because you can monitor the variances and they act as a metric, as a as a KPI, a figure of merit that you can see very easily whether your costs are going away from standard. Uh, that would be useful in industries like if you're making light bulbs or brewing bottles of beer and you make 10,000 bottles of beer every hour. Those kinds of businesses, those industries that is a lot of repetitive mass production, a standard cost makes sense. But if you're a contract manufacturer, if you do custom work, um, or other types of businesses, actual costing is preferable. So, in conclusion, the thing that you need to think about to achieve accurate product costing is that you have to have an ERP system that supports the cost collection, that is a manufacturing centric ERP system that will handle those costs correctly and that it uses a methodology that best aligns with your business. And it has to be set up correctly. It's not enough to have the right system. It has to be used correctly and set up correctly, and the transactional discipline needs to be good. And if that's all in order, then you will know your product costs, and you'll have a set of management information and tools that's going to help you manage the profitability of the business overall. And it also enables better profitability, as I said. It gives you management information that you can use for continuous improvement, things of that nature. And that's all I have. So I'm happy to take any questions. No
Looks like
questions.
we have a quiet group today. All right. Well, I will be sharing this recording with everyone who registered, so that'll be in your email a little later today. Um, yeah,
I did have one question. So, like,
there we go.
I'm a really small company. I don't even have an ERP system. What would be a good way to maybe track things outside of an ERP system?
And well, if you're a manufacturer, the thing is, well, it depends on a lot of things. You say you're a small manufacturer. I mean, if you're really small, you the normal way to do this is you would use QuickBooks and a spreadsheet. But at some point, and I would say rather quickly, if you have any kind of appreciable um, sales and demand for your product, that is going to it's not going to scale up. And the reason is the nature of manufacturing. Manufacturing is an industry, unlike services or consumer product or let's see, retail or services. Manufacturing has a phenomenon where you have to consume raw material that goes into work in process as it's being worked on in your factory. And then when the manufacturing work is completed, the product gets put into finished goods inventory. So you need a mechanism to do that, and the mechanism is a manufacturing order, or sometimes it's called a production order or a work order. You need a system that has a mechanism. If you don't have an ERP system, you don't have that mechanism. And to try and consume raw material for every production order and manage it through that workflow manually on a spreadsheet, if you have any appreciable volume, it's going to get old and tedious and inaccurate real quick. So, that's the attraction of some of these first, these tier one ERP systems like MRP Easy, that will bolt on to QuickBooks, and they will manage inventory, purchasing, manufacturing, and sales all in an integrated fashion so that the software is doing the work, not you. So that is a better replacement for a spreadsheet. And now some folks think that you can buy, well, I just want an inventory system. But without the manufacturing order, that inventory system is nothing more than a glorified clunky spreadsheet because you're still saddled with the challenge that the material consumption isn't happening. So without a production order that is integrated with purchasing, inventory, and sales and manufacturing, it doesn't make sense. Does that answer your question?
Yeah, it does. Yeah, it does.
Mhm.
I'm one person, so yeah, I can manufacture, I guess, on the scale right now just because I'm one person.
Yeah,
Eventually, I'll have to look into an ERP system, but like I said,
that's
I'm
right.
very, very, very small manufacturer, so an ERP system is out of the question right now.
Well,
Because
yeah. So you can get by with spreadsheet, and you'll just have to be meticulous, and I think that's perfectly doable. If you're small and the volume is small, and then when the time is right, then you uh, get an ERP.
okay, sounds good. Yeah, I'll just keep doing Word then and spreadsheets. Thank you.
Yeah, yeah, yeah. Now don't forget. I mean, some of these ERP systems they're pretty affordable. So of course, whatever your tolerance is for, it's another thing you got to pay for, but. MRP Easy, for example, boy, I have to look at the costing again. Since I don't pay for it, I don't know the cost the back of my hand. I think you can get it for like $60 per month for a single user. Um, so it may not be out of the question, but it depends on how much you are willing to pay.
Right, yeah, because I'm used to working in systems like Epicor and Global Shop were the systems that I used in industry, so those are
Yeah.
kind of quite quite hefty costs up front. So,
Well, they are, but those are T3 ERP systems, and so something like MRP Easy is a tier one. So it's for businesses like yours, but I don't want to suggest to you that you got to rush out and go buy it. If it's too much money, then just focus on the business and growing sales, and then when you're ready, you'll there's an affordable path to get that under better control.
okay, thank you.
Yeah, great presentation, David. What do you find? So I've come from larger companies, like so I'm the opposite end of the spectrum from Michaela. Came out of 3M a couple of years ago. Um, what do you see MRP Easy usually scaling to from a size of firm or size of
Well,
numbers or SKUs or whatever?
it's not the number of zeros that you have on your income statement. That's not the real uh, differentiator. It's the complexity of the business. So let's just contrast a tier one system with a tier three system. Um, SAP, Oracle, those kinds of things. Those are built for they have to be multinational, multi-currency, different business entities that flow up to consolidated financials. They may have a diversity of accounting methods and different, it gets complex when you got a big multi-billion dollar business. For a smaller business, if it's a single business entity, um, then you just don't need all that. And so that's where an MRP Easy makes more sense. Um, the largest company I've seen on MRP Easy was 25 million. Um, and there are larger companies that could be just, oh, actually, we got one right now that I think it's larger than 25 million. Um, but anyway, it's not the number of zeros. It's the complexity. Do you need this? Do you need that? Do you need milestone billing? Do you need project management? Usually the answer is no. And so you can afford to keep something that's simpler and more manageable and still gets the job done.
It's helpful. Thank you.
Yeah, actually, it's easier to apply a tier one system to a larger business rather than vice versa. You try and run a small business on SAP, you're going to be hating it.
Yeah, no, I mean, definitely coming out of 3M. I mean, now I'm a fractional CTO for smaller companies, but yeah, I mean, 3M is an extraordinarily complex, organization, as you might imagine, right? You
Yep.
know, 100 plus countries and tens of thousands of SKUs. So anyway.
Well, all right. I think we are ready to wrap it up. I want to thank you for your time, David. It was great
Yep.
information. And like I said, I will go ahead and share this with everyone, and hopefully we can have you back later.
Great. Yeah. Thank
All
you.
right. Thanks, guys.
Thanks all.
See you later.
Yeah,
Bye.
bye-bye.